Hey there, this is Ike Hoffman with Tactical Real Estate Solutions. We're about to walk through our redevelopment model. I'm really excited about this tool. It's kind of a hybrid between financial models that I'm already offering customers. It's kind of a mix between our value add model, our development model. It really takes components from both of them and creates this redevelopment tool. What is redevelopment? To me, redevelopment is a property, an existing multifamily property that's in need of a total repositioning. It could be occupancy issues, it could be a ton of deferred capital, but you're going to need to go in there. The property is not going to qualify for agency or bank financing like a traditional well-operated apartment building would. You're going to need to go get construction or bridge financing. That's probably a little more expensive. You're going to need to rip through these renovations, hopefully as expeditiously as possible, with the intent to refinance once you finish the renovations and the property is stabilized, hopefully at elevated rent levels. I'm going to keep this tutorial high level. Like I said, it's a hybrid between tools that I'm already offering to investors. There's already a ton of tutorial content out there on a lot of these tabs. I'm going to spend most of my focus on the Reno Inputs tab and the Capex Plan tab, as those are entirely new. It's different. It's something that even people that are using my current tools wouldn't be familiar with. And I just want to show how versatile and powerful these tabs are and how they give you a couple different options to really drill down into your renovation plan, down to the individual units if you so desire, or keep it broad if you need to work fast and you're dealing with a lot of deal volume and you need to tear through these underwriting exercises quickly and you don't really dive down deep into the weeds until you've made an offer or later on in the sales process. I'm going to reference the redevelopment model tutorial quite a few times. Just like any tool I develop, I have a tutorial that really is an all-in-one, one-stop shop to get all the information about how the tool functions and its capabilities. So the redevelopment pro forma, every single tab in the tool is hyperlinked here. I am constantly writing new content, uploading videos, creating learning materials so people can get familiar with the tool. Whether you're looking to buy it, I'm trying to show you whether or not it's the right tool for your business plan. If you already own the tool, I'm trying to create content that will help you master it and help you improve your proficiency in Excel and using the specific tools. So everything's hyperlinked here. So if you click on Capex Plan, for example, it'll take you down to the Capex Plan section. I actually wrote an entire blog post dedicated to the Capex planning, which will take you to a different article that talks about our Capex Summary tab. So I link to this webpage right from the financial model. So if you do purchase the tool, you can just click this link. It'll take you right there. It's also hyperlinked in the sales page as well. So you can go through tab by tab to hopefully determine if this tool is a good fit for what you're trying to do with your real estate business. Like all Tactica tools, brown text cells are your responsibility. Black text cells are either formulas or labeling. You don't need to touch them. If you want to alter some of your labels, that's totally cool. But if you're changing formulas and you're clicking into black text cells, just know that there might be deeper implications than you realize. I don't recommend that anybody touches anything that's not a brown text cell, as these models are a lot more sophisticated behind the scenes than one may realize. This model does have circular references. There's an option for an interest reserve, and whenever there's a capitalized interest reserve, unfortunately, that creates a circular reference. So every time you open this tool, you must go to File, Options, Formulas, and then you need to click this Enable Iterative Calculations. This will just ensure that the model works properly, given that there are circular references present. If you don't check this, the model won't calculate correctly, and it'll be apparent. There will be a lot of random lines everywhere. The workbook will be slow. So just every time you're opening up this workbook, get in the habit of just verifying that your iterative calculations are enabled. So we're on the Investment Summary tab. This is where most of your assumptions will be made. It's kind of a snapshot of all the major components of the particular investment. It's meant to be easily printed, so you can just go to File, Print. You can see it's ready to literally, you can print it as a PDF. Save it to your computer. Once you hit print, you'll determine which folder you want to save it in, and you can send this off to investors, partners, whoever is interested in the particular project. All pages are ready to be printed. I do ask, if you purchase this model, you keep it within your organization. I know maybe in the past you've sent financial models to lenders and other investors. I urge you not to do that. You paid for the right to use this. I truly think it gives you a leg up on your competition when evaluating distressed real estate. Please keep this within your own firm, and obviously reselling or redistributing is prohibited. So let's start talking about the investment summary tab. To upper left-hand corner, your general property information, pretty self-explanatory. You can enter in the basic data points of your particular project. If you had a picture or a map or a rendering, you could copy and paste that here. The unit mix summary, the floor plans and how many floor plans exist, that's flowing in from a different tab we'll get to shortly. Nothing you need to do there. It should update automatically as you're filling out the workbook. Financing year zero. This will be your bridge or your construction financing. You would enter in a LTV or an LTC, loan to cost assumption here. You can choose which one. Your interest rate, your term, pretty self-explanatory. I also allow for an assumption that determines if there is standard interest accrual or pre-drawn. Standard, it's more customary. Borrowed funds won't accrue interest until you actually spend those monies, until you actually draw them and spend them. However, I have seen term sheets where interest is pre-drawn, meaning although you haven't drawn funds yet, every single dollar that you're going to potentially borrow begins accruing interest day one. As the investor, you hope for standard terms. It's cheaper. Interest expense will be cheaper with standard, but I have seen pre-drawn, and I wanted to give investors that option in case you have a term sheet that requires that. Loan cost is a percentage of total loan. You'd enter that in here. I just have 1% plugged. And then I also have an option for an interest reserve. I'll touch on this more a little later on, but I've seen some lenders that don't have an interest reserve, meaning they're expecting you as the investor to pay interest expense from cash flows from the property even during the renovations, while others will fund an interest reserve and you can actually borrow on that. So if you got a 75% LTV loan and they required a $1 million interest reserve, you'd be able to borrow $750,000 and then draw on those funds to pay the interest every month. I have no selected right now. No is probably more prevalent, but I have seen it both ways. The summary of rents and the renovation plan, this is pulling from the Reno Inputs tab. The Reno Inputs tab is really the meat and potatoes of the renovation analysis. That information is just being summarized here. For return on cost calcs, you can see we're solving for a 34% return on cost. I didn't know whether or not investors would want to include construction interest. I've seen it done both ways, like on a new development project, the capitalized interest reserve would be included in the total construction cost. When you're doing like a yield on cost or return on cost calculation, you would be factoring in the interest reserves as part of the cost, but I give you the option. So notice it's a brown text cell. You can either do it with just the rental capital, true capital items, or you could do capital and interest. If you do capital and interest, the expense will be greater, which then drops the return on cost. Switch it back just so you can see that change. And then there's just a nice little pie chart summarizing where you're spending money, whether it's interest, interior capital, so the actual money you're spending on units, or common areas, hallways, exteriors, marketing, contingencies, those types of things would be common and other capital. Once you are ready to refi, you'd enter in your refinance assumptions here. You need to choose what the market cap rate will be and then what LTV a permanent lender would give you. The model's smart. It can look up what the stabilized NOI is once the renovation is completed, and that would determine the total refi proceeds. It summarizes when the refinance month takes place, the refinance year. The model just assumes once you're done with the renovation, you're going to refinance. Well, technically, it assumes 1 month following the completion of the renovation, you'd refinance. And then just a lot of these deal metrics are summarized, so you'd be able to, in this scenario, pay out 22% of the original equity that was invested would be paid back to investors via the refinance. There would still be $3.2 million in the deal. You got a healthy debt service coverage ratio in year 3. And then some other metrics are summarized as well relating to the NOI refi and the valuation at refi. If you did do a repositioning fee, I've seen some syndicators do this where they'll charge like 1 or 2% of the refinance proceeds. You could plug that in here. I'm going to leave it at 0%. You'll actually type in your permanent refi, your permanent financing terms over to the left. Notice that the LTV is a black text cell. That's because it's actually just pulling from what we just put in over here. The interest rate, the term, the amortization, the loan cost, if you get interest-only months. I currently have 24 months in there. You'd enter all that in here. And then the project level metrics, arguably the most important part of the analysis. You're determining how much you're going to pay for the asset in your hold period. Depending on your hold period and how much you're paying, it's going to affect IRRs, cap rates, stabilized yield on cost. Stabilized yield on cost is an important metric in my opinion. That's why it's highlighted blue here. It takes your stabilized NOI post renovation divided by purchase price plus total construction costs. So the hope would be that you have a nice spread between the yield on cost than the market cap rate when this project's completed. Your sources and uses are summarized in the bottom left-hand corner. If you did have any other costs that you wanted to factor in to the initial capital outlay, you just need to make sure to enter that in as a negative. I have a note there. So maybe you just have a $55,000 reserve. You can plug that in there, and that would then flow into the overall pro forma cash flow. You have some residual assumptions summarized, nothing you need to type in here, but we're doing a 6-year hold. Let's change that back to 10. So it just summarizes what your residual cap rate would be in year 10. We'll talk about how to make this assumption here in a second. Your residual sales price, total appreciation that's taken place over the investment hold, also that appreciation on an annual basis, and just some sort of total sale proceeds stuff as well. On the topic of residual cap rates, you'd make these assumptions over here. The model is smart. It allows you to look at the returns over various investment holding horizons. So you would need to enter in what the residual cap rate is on this property as a stabilized property today and how much you want that residual cap rate to increase by each year. So in this case, I'm doing 10 basis points on a 10-year hold. That would be the 5% residual cap rate would increase by 100 basis points, and that's how the 6% is being calculated as residual cap rate over here. Any closing costs, any acquisitions fees, if you're a syndicator, you'd enter those in here. You don't need to touch anything up here. And then when you sell the property one day, it would be wise to plug in a brokerage commission as a percentage of sales price, any other closing costs, and if you're charging your investors a residual sales fee, plug that in here as a percentage of sales price. I have multiple partnership tabs. I'm not going to talk on those too in depth during this tutorial. These partnership models are identical to what I already have in the development and value add models, and I have a ton of content out there. Again, they can be referenced from that tutorial we've already discussed. You just come here, partnership distributions, and then I have 3 different articles explaining them in depth, even some videos as well. Let's move on to the renovation inputs tab. This is likely where you're going to be spending the most time. I'm going to show you 3 different ways you can use this tab, and there are infinite other ways as well. And over time, I'm going to continue to publish more tutorials and make more videos just showing how versatile this tab can be depending on your investment strategy. But I think for the purpose of this tutorial, showing you 3 where we get incredibly granular, we go kind of middle of the road, and then we go very broad for those people that need to work fast, that should give you a good idea of what this tab is capable of and how you may want to use it. So the example we're looking at now, this is kind of middle of the road. On the left side here, you have these 8 different sections. These sections can be anything you want them to be. You could call them first section, second section, third section. You could call them first block, second block, 8th block. In this example, I'm calling them floors. I have a theoretical apartment building that has 8 floors, and I'm knocking off the renovations floor by floor. Off to the right here is where the analysis starts. We have floor plan inputs and an air check. First thing you always need to do is you need to enter in the unit types or floor plans that are present in the unit mix at the property and the square footage. You can get as granular as you want here. I'm just going, 1 bedroom, 2 bedroom, 3s. I guess there's 2 bedroom, 1.5 bath, 2 bedroom, 2 baths. But if you had a unit mix that, maybe there were 5 unique 1 bedrooms, A, B, C, D, and E, well, you could do that as well. You could go all the way to letter Z, put in all the square footages, and get incredibly granular. Like I said, this is kind of the middle of the road analysis, and I'm just going to go unit types. I think that's sufficient for what I'm doing here, and quite frankly, most of the deals I'm working on, this would be more than enough. Off to the right here, these are black text cells. As you begin to enter information into the grids, into the sections, this will populate. The air check is crucial. You need to be using this section. The unit types and the square footage will populate automatically as you're entering in your assumptions here. But you also need to type in the high-level business plan of what you're expecting for your renovation program. So you need to put in how many units there are for each floor plan, the average rents for each unit type or floor plan, the average premiums, and the average capital spend. I've never met an investor that didn't have this information ready to go, and it literally will take you 10 seconds to plug it in. Why this is important is, like I said earlier, this information is pulling from the renovation plan off to the left. If you make a typo and put in 6 bedrooms instead of 5, the cells will glow red in the floor plan input, notifying you that there's an error. So because you put in 6 instead of 5, the 1 bedrooms are 1 unit too much, the total units are 1 bedroom too much, and this skews average rents and average premiums. You need to come back, find your error, fix it, and once you do, the red or pink will go away. Same could happen with capital. Maybe you actually accidentally enter 9,000 instead for the 3 bedrooms on the 4th floor. Because you took the time to enter in the overall high-level renovation plan, the floor plan inputs will glow red, and you know that you have an error and you need to find it. Once you fix it, everything will be good again. Off to the left, I have 8 separate sections where you'll dial in your renovation inputs. 8 just seemed right. It doesn't mean anything. I just wanted to give you, the user, flexibility for how you want to structure your renovation program. Most properties that I work on, I use at max 4. I think that's sufficient, but I wanted to leave 8 just in case for the ultimate flexibility. So with each section, you're either plugging in units that are going to be renovated, or you, like I'm doing here, I'm grouping floor plans. So I'm doing 8 units in block 1, 8 units in block 2, 12 units in blocks 3, 4, and then 12 actually for the remaining blocks. You can do whatever. I truly built out the renovation section to be able to handle all kinds of creativity and hopefully fulfill a lot of different preferences. So let's talk about the first floor. I have these 8 units in here. Again, it's kind of a generalized analysis at this point, right? Because I'm plugging in the 1 bedroom 2s and 3s, the unit counts, the average rent, the premiums. Realistically, right, the rents are going to be different on the first floor versus the second floor, third floor. If you want to get that detailed, you can. I personally don't think it's necessary. It's not going to make a material difference in the deal, but you're more than welcome to. The first set of assumptions has to do with renovation timing. The month start in the first block, it's always 1. It's a black text cell. The model assumes you're starting the renovation right away. The rehab duration is 2 months. The lease up is 1 month. So you finish construction. I'm assuming it takes 1 more month then to lease it up, which makes these 8 units officially rented month 4. Right? Because in months 1 and 2, you're renovating. Month 3 is lease up. And on the first day of month 4, rented. And then you need to make some assumptions off to the right. So cash for keys. I've had some clients and I've talked to some potential clients about their willingness to pay tenants to vacate the unit earlier than their lease requires. And they have short-term financing, bridge or construction financing. It's beneficial for the ownership group to get people out as fast as possible, and they're willing to pay for that. So if you want to have a cash for key program, cash for keys meaning you're willing to pay a month of rent or 2 months of rent for that tenant to vacate early, you'd stipulate that assumption here. Just to reiterate, these assumptions you're making are applying to all 8 units that we plugged in here. Just these 8 units. General occupancy post-rehab. So when you finish the rehab, what's occupancy going to be? 95% will be common. If you want to be more conservative, you could do like 90%. Annual increase post-rental. Even if you're going to raise rent significantly, hopefully you still get inflationary rental increases year over year. I'm stipulating 2% for this particular block. So these units will lease in month 4, and then every 12 months after they're leased, a 2% rental increase will phase in over these 8 units. And that will happen for the duration of the investment hold. And finally, lease up concessions. Well, you have to incentivize people to lease these units. I have 1 month of rental concessions plugged in there, meaning for these 8 units, the target rent is $1,630. I'll have to give away $1,630 times 8 to get these units leased up. Again, you're making this assumption in terms of months, and you can do all the way from 0 up to 3 months. You're going to make these same assumptions for each section. Sections 2 through 8 are a little different from the first section because there's one extra thing we need to account for, and that's occupancy pre-rehab. Well, we're starting the first batch right when we own the property, but for everything else, we need to make an assumption for what the occupancy is before the rehab starts. If it's an incredibly distressed deal that's 50% occupied, you might put in 50% and do that across the board. What's nice is once you make your second assumptions, if you want to keep it consistent across the board, you can just copy and paste everything to save time. Now, if you want to go through them one by one, again, this analysis can be as granular or as detailed as you want, but it's not. I would say it might be a little overkill. Maybe you want to do something just on the last batch of units, the units on the 7th and 8th floor. Maybe you want to increase concessions. You hope the demand is there, but you want to play it safe. So you'll add more concessions only in these 2 sections. You can have unique assumptions like that and be able to distinguish units that may be a little softer later on in the renovation cycle. So just to summarize, you don't need to use all 8 of these sections. I'm doing it here just to show you the model's capabilities. I think you can get away with a lot less, and I'll show you an example of that. Let's talk about a property that's 36 units. So it's manageable, and you want to actually drill down to the individual units and plan the renovation that way. I actually wrote a blog post. So let's go back to the top here. We're going to go renovation inputs. Click this first link. And I actually detail a 36 unit property where I'm looking at the rent roll, I'm looking at the lease expirations, and I'm planning the renovations when residents will be vacating their units. Organize the rent roll. I get everything structured so it's all the month-to-month units are first, and then we go into May, we go into June, and then all the vacant units are at the bottom. So the final summary, you can see I'm using 4 different blocks. Instead of calling them first floor, second floor, third floor, or first block, whatever, I'm actually calling them the first block of units we're going to renovate are month-to-month and vacant. The next batch would be May expirations, June expirations, and the July expirations. You can see I'm actually accounting for the actual units here, which is an optional column. You don't need to get this granular, but it's there if you want to. I'm keeping the premiums pretty much steady. The rents are a little different, but I'm just doing $200 for 1 bedrooms and $250 for 2s, and I'm doing a $9,000 capital spend regardless of if it's a 1 bedroom or 2 bedroom. You can see this renovation is going to take under a year. Knocking these out pretty fast. We can get right in, hopefully take care of these month-to-month and vacant units. And then July expirations, you'll notice it's the only block that has a cash for keys. In this particular example, there's actually leases that expire beyond July, but I'm assuming that we could convince the tenants to vacate early by July by giving them 1 month of the average rent, which in this case is $726. So by paying these 5 units $726 a piece on average, you pay unit 201 $725, 202 you pay them $710, and you could get them to vacate, so you could take care of these expirations and then knock them out in July. Once you have all that plugged in, the cash flows again will be summarized nicely. The Capex plan will be summarized for you with some nice charts that I'll touch on a little more in depth shortly. You can see that the property's totally stabilized by year 2. But what about the other end of the spectrum? So the third way I'm going to show you is, let's say you have a large property, 400 units, and you want to use this model, but no way you're going to be plugging in 400 individual units, and even grouping them by floor plan, like we did in the first example, would be incredibly tedious. So you need a quicker way. Let's talk about this case study where we have 400 units. So the first step always is to enter in your floor plan inputs. So we're still going to put in our 1s, 2s, and 3s, the square footage. We're going to enter in the high-level renovation plan, so how many units there are for each one, the average rent, the average premium, the average capital. But now we're focused on what's being calculated down here. the blended averages of the square footage, the rents, the premiums, and the capital. So I forgot to mention, the reason why we enter all the information here first is because then when you're filling out the grids to the left, it creates this drop-down menu where you can actually pick what floor plan you want. And then depending on what you pick, that square footage, it's a black text cell, will populate automatically. So we do a 1-bedroom, 1-bath. You can see, because we typed in 800 here, 800 will populate. It just helps prevent data entry errors and will help you work quicker as well. But what we want to do is we want to go all the way to the bottom of this list, click blended. There's 400 units, and we want to allocate that renovation over all 8 sections. So in this case, I'm just calling them sections. So literally typing it in here, you can see that's what's actually determining what the section's called, is what you're typing in the section name cell. So we have 400 units over 8 sections. That's 50 units per section. So we're going to grab blended, we're going to type in 50. We're going to grab the average rents from down here, type it in. We're going to get the premium from down here, type it in. And then the blended capital is 9,600. What's nice is once you have the first one entered in, you can just copy and paste, again, to save time. All the formulas are identical. You're not going to mess anything up. You'd go through all 8 sections, pasting that information into each. You need to set up your assumptions like we did in that first example. So your month start, each section we're going to do 50 units in 3 months. So that's like 16-ish, 16 to 17 units a month. Lease ups are going to take 1 month. And then the month rented is summarized for you. Again, we're going to go all the way through. We're going to put in these assumptions. I'm doing a half a month for cash for keys, 90% occupancy pre-rehab, 95% post, 2% annual increases reno, and then 1 month of lease up concessions. I'm keeping that steady all the way through. So I can literally just copy and paste it. I already have it plugged in, so I don't need to. This particular renovation will end in month 24. So the last section will begin in month 22. It's going to take 3 months. So 22, 23, 24. Go to the Reno Summary, everything, all the graphs, the general renovation information is summarized, the key cash flows, your capital, your construction interest, and then the graphs as well. We haven't talked about common area capital yet, but it's summarizing how much you're spending in interior capital, how much you're spending in common area capital, and then individual unit information as well as off to the right. So how many units you're renovating each month, and then that cumulative is the blue bar. Cumulative capital is also being tracked on the left as well. So again, this is the broad way to do it. You're going to have red, right? Because we're not actually getting as granular as the individual unit types. But as long as nothing is glowing red down here, we know that our analysis is accurate and that this blended approach will work. I think this is more than sufficient on larger deals. You're not really sacrificing any accuracy. I mean, realistically, I guess in theory, you could renovate more 2 bedrooms or 3 bedrooms earlier, which have higher rents, and get more early on. But it's just not going to make a material difference in the overall returns. You're going to be able to work fast. That's equally as important, especially if you have a significant deal volume where you just need to be able to continually assess and analyze properties and move on if they are passing the sniff test. The Capex Plan is another tab that's totally unique to the redevelopment model. It really allows you to get detailed with your common area capital, your exterior capital, your project management costs, your contingencies, your marketing expense. The interior units and the keys for cash, that's flowing in directly from the Reno Inputs tab, which we just did. You may notice that interest expense actually has been staying steady the entire time. It's not increasing as we increase more funds. That's just because on the Investment Summary tab, I left this as pre-drawn when I was explaining it earlier, which means all funds that a lender is willing to give you will begin accruing interest day one. Well, if we go to standard and then come back to this tab, now it's ramping up as you're spending more money on the project. There is some conditional formatting on this tab to help prevent errors. When the rehab duration is done, this ties to the Reno Inputs tab. So when you're done with units, you should be done with all this common area capital. If you're not, for example, you have painting at 26, it'll glow red. This is just telling you hey, your painting projection doesn't make sense. The renovation is finishing in month 16 and you're refinancing month 17. Nothing should go beyond that. So you need to put that back at a number that's at a month that's less than the rehab duration. This is helpful because what will happen is you'll come back to the rental inputs and you'll play with the timeline and you'll speed it up or you'll draw it out. And if you speed it up and you're doing a renovation in 18 months instead of 24 months, but a lot of these assumptions go out to 24 months, they'll all be glowing red. So you need to change them to match the interior unit renovation timeline. The interest expense is being calculated automatically. These are black text cells. You don't need to do anything here. Your loan balance is being tracked. So typically with these construction deals where there's extensive renovations, you'll draw on the construction loan to be able to close on the property, and then the loan proceeds will tick up as you spend more money on the construction. So you can see here it maxes out at 11.481 million, which ties to the total construction proceeds that we were solving for when we began this analysis. There's also a reboot. So maybe you make a typo on this tab. The interest expense, this is the line that ties to the circular reference, and this is why it's a different color, slightly darker color. You need to be very careful with this row and never make any alterations. But you might do something like this. Instead of typing in 20,000 for marketing, you actually hit Q. Now there's an error. You hit back quick. Oh no, the interest expense is still an error. What do? Whatever you type in here, when the reboot glows red, you switch it to yes. You fix your mistake, 20,000. It's still glowing red, so there's still action, and then you hit no. Now the interest expense is back to calculating that 589,195. So just back to this rental summary tab quick. All of the common area capital are the gray bars here. That's all being summarized in this graph as well, and the annual cash flows are summarized as well. The real estate tax tab, this is identical to what is presented in both the value add model and even the free model I give away for being a Tactica email subscriber. There's nothing I really need to explain here too in depth. I have 2 different tutorials explaining this in depth. Just big picture, you're always trying to figure out if there's going to be property tax exposure if you're paying a price greater than the current assessment. In this case, the property is assessed at 11.3 million. We're looking to pay 14 million. So there's going to be a pretty significant assessment increase once the assessment community, the county assessment community, figures out that the sale happened. So in this model, I'm going to 100% of sales price. I'm having that phase in year 3. You can see pro forma year 3. The assessment goes up, which means property taxes go up as well. Again, I have 2 different blog posts explaining this in depth, and it's the exact same as in 2 of my other tools that I offer to viewers and customers. The financials tab is also identical to what you do in the value add tab and in the free financial model that I give out to Tactica email subscribers. You're going to enter in all your historical data in columns E through H. It's probably not as prevalent if you're doing a total redevelopment. You probably don't really care about what historical revenues are and potentially even historical expenses because you're going to come up with your own once the property's stabilized. But if you do want to enter them in, you do that there. You make all your assumptions out here, columns W through AK. Years 1 and 2, I give you a lot more. I give you some flexibility in how you're making these assumptions. You can either do it as a percentage increase over the previous year, doing a lot of 3% growth on miscellaneous income and expenses. You can make your assumptions as a percentage of gross potential rent. So like bad debt, I'm doing negative 50 basis points of the total gross potential rent, or as a percentage of total effective gross income for expenses. I'm doing a 5% management fee, which is 5% of the total revenue, or you can do it on a per unit basis. So notice I have marketing, repairs and maintenance, and turnover zeroed out in years 1. Why are they zeroed out? Because we're already accounting for them in our Capex plan. I have a marketing budget that I'm financing, technically. Interior units, that would normally be R&M. We're renovating units. There's not going to be turnover as units turn. We're going to be plugging in the renovation capital. So marketing, R&M, and turnover are 0. And then once the property is stabilized in year 2, then I'll put in an appropriate assumption on a per unit basis for what I think this property would operate at once stabilized. And then in years 3 through 11, it's just pretty straightforward. 3% increments every year, gradual increases for all the line items, with the exception for management fee. That's just going to be a 5% of EGI. And then all the operating cash flows are summarized off to the right. The return summary is also identical for the most part to what the value add model looks like, what the development model looks like, and even our free template. There's a couple other things I want to talk about, specifically the refinance. I added a couple of rows that account for the refinance. So these would be your permanent financing, blowing out your construction loan, and then typically your permanent financing will have some fees associated with it. You're going to pay a mortgage broker. Those would flow out of the refinancing proceeds as well. And then the total refinance proceeds are summarized here in row 40. I do want to talk about the bridge and construction interest. So in this particular example, we're assuming that the lender would require you to make interest payments with cash flow from the property during the construction period. However, there might be instances where a lender is willing to fund an interest reserve. In this case, right now we have it selected as no, but if it was yes, now when you come to the return summary, there's nothing here. It's zeroed out. That's because now that interest expense is included in the renovation capital, and it's assuming that you're going to be able to draw on your construction loan proceeds to be able to pay the interest expense every month. You can just click this little dash over here to hide the bridge financing line just to prevent any confusion. All the major assumptions are summarized. So you have your permanent financing loan terms, your construction or bridge loan terms summarized up here, some closing assumptions. In this section, all your cap rates are summarized. The big one that jumps out at me is your stabilized cap rate FY3. So the model's taking your stabilized, your NOI as soon as the property is stabilized and dividing it by this 14 million. So yeah, the deal's pretty skinny, right? When you're going in on looking at the previous owner's historical financials. But if you can execute your business plan, obviously there's a lot of upside. If you have an asset management fee, you could plug that in here. I have 0% entered, but if you did 1%, it's going to take 1% times the effective gross income each year. Put that back to 0. All the IRRs, equity multiples, all cash and cash on cash returns are summarized below. One important thing to note, the model's smart. Not only does it allow you to look at different holding periods and see what the returns would be if you hold for 6 years versus 10 years versus 2 years, but if you're looking at the IRR for year 2, this 33.25, oh, that seems like a good IRR. The model knows that you wouldn't refinance, pay a bunch of fees to a lender, and then go sell it. The model will assume that if you sell in year 2, the year that the refinance takes place, you're not going to ever put on any permanent financing. All you're going to do is you're going to sell it and blow out the construction loan. Construction loan summarized right here, the 11,927,985. But if for example you decided to sell year 3, the model will assume that you get this 460 grand in refinancing proceeds, and then the following year you'll get your sale proceeds, and then you'll blow out the permanent financing. So any year after the refinance that you're looking at the IRRs or other investment metrics, it assumes that you do take the refinance proceeds. It's just the year of. If you're looking at the IRR, the year of the refinance, the model knows not to include this. It's excluding these cash flows. And quickly, just obviously the residual value is a huge component of any real estate deal. Remember, we set these assumptions over here on the investment summary tab. So we start at a 5 cap and we're increasing it by 10 bips every year. That's where these assumptions, residual cap rate assumptions, are coming from, which is giving you the residual value ranging from 15 million before the property stabilized all the way up to 18.5 in year 10. All of your cost to sell, your costs paying your brokerage fees and deed tax, those types of things will be deducted with the assumptions you're making here as well. If you have your residual sales fee, that would flow into this acquisition/disposition. The refi debt tab, there's nothing you need to do here. When you're plugging in your permanent financing terms, the permanent financing at refi section, this is just the amortization table that tracks everything, that's tracking your interest only if you have that. It's actually a pretty powerful tab, but there's nothing you need to do here. It's just hosting some pretty crucial information. The IRR sources, I have 2 different blog posts on IRR sources. It's a unique metric. It really shows you the different sources of your IRR. So are you getting it from appreciation? Are you getting it from paying down debt, from your cash flow, from growing cash flow, from the refi? The IRR sources will direct you to how it's being calculated in this particular analysis. And then the partnership returns. I have a ton of blog content on the partnership models that really breaks down how I'm calculating my preferred return cash flows, or my IRR waterfall. So again, if you go back to the tutorial, go to partnership distributions, I have 3 different blog posts that really go into the weeds explaining specifically the preferred return, the IRR waterfall, and then just another ancillary article kind of comparing all of them together and explaining Tactica's rationale and how we're using these tools. And then finally, the last partnership summary tab just compares these different partnership models. It's conditionally formatted, so the darker the cell, the more beneficial it is to the partner. So the GP's in green, the LP's in purple. For example, the profit, interest, and pari passu model, everything's glowing darker green, which means it's more advantageous to the GP. And on the flip side, if you go over to the LP, there's not a lot of dark cells here, so this would be the least advantageous for the LP. This is a nice tab just to kind of quickly compare these different partnership models. It provides you the ability to do kind of an apples-to-apples comparison, experimenting with a preferred return versus an IRR waterfall versus an equity multiple plus sale kicker, and just see how that would look for both the GP and the LP. And hopefully you can find a middle ground that makes sense to both investment groups. One other thing on the partnership returns, if you are doing acquisition fees, disposition fees, repositioning fees, or asset management fees, they'll all flow into these partnership models. So not only will you know what your cash flow will be from the project, but you can also get a calculation on these various fees and then total fees plus distributions. So that concludes the video. Hopefully this tutorial gives you an idea whether or not this tool is a good fit for your particular business model. Again, I have really 3 for sale models for multifamily. That's my value add, development, and now this redevelopment model. The redevelopment model is kind of a hybrid of both those. It's for properties that need a total repositioning, meaning you're not going to get bank or agency financing. You're going to go construction or bridge financing with the intent to refinance as soon as the property is stabilized, and it allows you to get much more granular with your renovation program than, say, our value add model. Spend some time on the tutorials, go through tab by tab and make sure that you're comfortable with the tool. I'm happy to answer any questions. I don't have a return policy. Obviously, the digital nature of this product, it's impossible to sell it and return it if you're not satisfied. So please ask me any questions on the front end about the model's capabilities, about what it can do, and I'll help you determine if it's a good fit for your business. Appreciate you taking the time to watch. Let me know if you have any questions. Take care.